The greatest fortunes in history weren't built by those who knew when to buy. They were built by those who knew when to sell. And here's the paradox that will make your brain hurt. The skill that creates wealth is precisely the opposite of the instinct that got you there in the first place. The same hunger that drives you to spot opportunity becomes the chains that keep you locked in past your exit. The same conviction that makes you a winner makes you a loser. This isn't motivation. This is physics. Think of your position, any position, stock, business, real estate, as a rocket in orbit. Getting into orbit is hard. It requires massive energy, perfect timing, and balls of steel. But here's what NASA knows and you don't. Staying in orbit burns no fuel. Leaving orbit, that's when you need thrust again. That's when you fight gravity. And your brain, your beautiful pattern-seeking survival machine, treats every exit like jumping off a cliff. Because that's exactly what it is. Your ancestors who saw a berry bush and thought, maybe come back tomorrow, starved. Your ancestors who saw opportunity and squeezed every last drop, survived. You are their descendant. Your DNA is coded for more, never for enough. This served you for 200,000 years. In markets, it destroys you in 200 days. The sunk cost gravitational field. Here's what's happening in your brain when you're up 50% and you can't pull the trigger. MIT neuroscientists ran traders through fMRI machines while they made buying and selling decisions. When subjects bought an asset, their nucleus accumbens lit up, the same region that fires during cocaine use. But here's the kicker. When they sold for a profit, there was a secondary spike in the anterior insula. That's your pain center. Winning hurt, literally. Taking profit activated the same neurons as touching a hot stove. Your brain interprets selling a winner as loss of future gains. And loss in the neural economy is weighted 2.5 times heavier than equivalent gain. This is called prospect theory, and Daniel Kahneman won a Nobel Prize explaining why you're terrible at this. Watch a gambler at a slot machine who's up $500. They don't cash out. They keep pulling. Why? Because their brain isn't measuring money anymore. It's measuring trajectory. They're not up $500. They're on a path to $5,000, maybe $50,000. The possibility curve has hijacked the actual profit. This is why lottery winners go broke. This is why startup founders watch their paper billions evaporate.
This is why you're still holding that position you should have sold 6 months ago. Jesse Livermore, the greatest trader of the 1920s, made and lost 3 fortunes. Each time he lost it the same way. He couldn't exit his winners. In 1929, he shorted the market perfectly and turned $10 million into $100 million in weeks. He knew the crash was coming because he'd studied panics his entire life. But when it came time to cover, to take his short profits, his brain couldn't do it. He waited for more. The market bounced. He gave back $40 million in days. He later wrote, "It never was my thinking that made the big money for me. It always was my sitting." True, but he left out the second half. His inability to stand up and walk away destroyed him 3 times. Here's the practical exit. Pre-commitment devices. Ulysses tied himself to the mast before the sirens sang. You need to do the same before you enter the position. Not after, before. When your nucleus accumbens is quiet, write down 3 numbers, your entry price, your target exit, and your I'm being greedy exit. The target is based on rational analysis. The greed number is 30% beyond that. If you hit the greed number, you sell half automatically. Not because you want to, because you decided when you were sane. The richest investors I know, the ones with generational wealth, they all have one thing in common. They sell on the way up. Always. They never catch the top. They don't care. They optimize for exits they can live with, not exits they'll brag about. The endowment inflation trap. You bought a stock at $20. It's now $80. In your mind, you don't own a stock. You own an $80 generating machine. Selling it means losing that machine. Economists call this the endowment effect. Once you own something, your brain overvalues it by 200 to 300%. This isn't a bug. This is a feature. In ancestral environments, your spear was life. Trading your spear for a slightly better spear carried catastrophic risk. Better to keep the spear you know. Your brain still thinks you're trading spears. It has no idea you're trading liquid financial instruments in a market with 10,000 other opportunities. Studies at Duke University tracked venture capital partners across 20 years. The partners who generated the highest returns had one characteristic that separated them from everyone else. They felt less ownership over their winners. Neurologically, their endowment effect was blunted. They could look at a portfolio company that had 100 times and think, asset that could be exchanged for other assets, instead of, my baby. The bottom performers? They talked about their winners like parents talk about children. This company is going to change the world. Maybe, but you're an investor, not a missionary. The moment you confuse the two, you stop making rational exit decisions. Think about venture capital mathematics for a second. A top-tier VC fund might invest in 30 companies. They know, statistically, that 20 will fail, 8 will return 1 to 3 times, and 2 will return 10 to 100 times. The entire fund's returns come from 2 companies. 2. So what does every VC firm do? They have partnership meetings every quarter where they discuss one question. If we didn't own this, would we buy it today at this price? If the answer is no, they explore exits. They've removed time from the equation. They've removed ego from the equation. They've removed the sunk cost fallacy from the equation. All that remains is this the best use of capital right now? That's the only question that matters. And that's the question you're not asking. Here's your practical exit, the replacement test. Every Sunday, review your positions. For each one, ask, if I had cash instead of this position, would I buy it today at this price? If the answer is anything other than hell yes, you sell Monday morning. Not eventually, Monday. This is how professional money managers think. They don't have positions. They have current best uses of capital. The moment something stops being the best use, it gets replaced. Your attachment is costing you compound interest on better opportunities. The peak blindness paradox. Here's a truth that will mess with your head. You can never know you're at the peak until you're past it. Peaks are only visible in retrospect. This seems obvious, but your brain doesn't operate this way. Your brain thinks it can see peaks in real time. It can't. What it actually sees is momentum, and momentum at the peak is maximum. That's why peaks feel like they'll last forever. That's why every bubble participant thinks this time is different. The dopamine isn't lying to you. It's reporting accurate data about right now. It just has no predictive power about tomorrow. Neuroscientists at Stanford ran an experiment. They showed traders price charts, some real, some random walks. The traders were asked to identify tops and bottoms in real time. Performance was 51%.
Barely better than chance. But here's what's interesting. Confidence ratings were 78%.
Traders were absolutely certain they could see turns coming. They couldn't, but their brains gave them the feeling of certainty anyway. This is called the illusion of validity. Your pattern recognition system works so well in other domains that you trust it completely. In markets, it's practically useless for timing exits, but it feels useful. That feeling kills you. Look at Bitcoin in December 2017. It hit $19,783. Everyone who bought at $15,000 felt like geniuses. They'd made 30% in weeks, but they didn't sell. Why would they? Momentum was parabolic. Every dip got bought. The narrative was clear. Digital gold, institutional adoption, supply cap. All true, all irrelevant to timing your exit. Your brain was reading the room, and the room was euphoric. 3 weeks later, Bitcoin was at $11,000. 6 months later, $6,000. A year later, $3,200. The people who made life-changing money from Bitcoin weren't the ones who bought at $100. Those people mostly held to $1,000 or $5,000, thinking it would go to $100,000. The ones who made life-changing money sold at $12,000 or $15,000. They didn't catch the top. They caught enough. And enough is the only top that matters. Here's your practical exit. Scaling out. This is the single most powerful tool for dealing with peak blindness. You never sell your whole position at once. You sell in tranches. Let's say you want to exit a position. Sell 20% today. Sell another 20% when it's up another 15%. Sell another 20% when it's up another 15% from there. Now you've got 40% left and you're playing with house money. That final 40% can go to the moon or crash to zero. You've already won. This strategy does something magical to your psychology. It removes the need to be right about the top. You're not trying to be perfect. You're trying to be profitable. Rich people understand this distinction. Poor people think they're the same thing. The FOMO aftershock cycle. You sold. The position keeps going up. Now you feel like an idiot. Your friends who didn't sell are making more money. You're out here with your profits, feeling like you lost. This is the aftershock. And this is where most people make the catastrophic mistake. They buy back in. Higher, because they can't stand watching the parade without them. Then, because the universe has a sense of humor, that's when it crashes. You sold at $80. It went to $100. You couldn't take it and bought back in at $95. Now it's at $60, and you've turned a win into a loss. This cycle has destroyed more wealth than market crashes. The psychology here is brutal. When you exit a position, your brain doesn't classify it as closed trade. It classifies it as ongoing experiment I'm no longer participating in. Every uptick after you sell registers as counterfactual loss. Your anterior cingulate cortex, the part of your brain that detects errors, fires continuously. You made a mistake. You left money on the table. Your tribe is winning without you. In ancestral terms, you left the hunting party early, and they killed a mammoth after you left. That's social death. That's why watching your sold position go higher hurts more than watching a position you never owned go up. One is theoretical. The other is personal. George Soros broke the Bank of England in 1992. He made $1 billion in a single day shorting the pound. Historic. Legendary. But here's what nobody talks about. He closed half his position the week before the pound crashed. He knew he was right. He knew the trade was perfect. But he also knew that being right and being early are indistinguishable from being wrong. So he took half off. Locked in profit. reduced risk. When the pound collapsed, he made less than he could have. And he slept fine. Because he'd learned the lesson that took him 30 years to learn. The money you take off the table is the only money that's real. Everything else is a number on a screen. And numbers on screens go to zero faster than you can blink. Here's your practical exit. The gratitude protocol. When you sell a position and it keeps going up, you do something specific. You write down what you made. You calculate what it means in real terms. This $15,000 profit pays for 3 months of my kid's daycare. Or, this $150,000 pays off my student loans. You make the abstraction concrete. Then you say out loud, I made money. Other people lost money in this same market. I won. This isn't psychology. This is rewiring. You're training your brain to classify closed, profitable trades as victories, not missed opportunities. The richest people I know do some version of this. They celebrate exits. They don't mourn what they left on the table. They throw parties for selling too early. Because selling too early is the only way to be sure you're not selling too late. The narrative lock syndrome.
By the time you've held a position for months or years, you don't just own the asset, you own the story. You've told people about it. You've defended it in arguments. You've read articles that confirm you're right. You've become emotionally invested not in the price, but in being right about the price. And your brain cannot separate these two things. Selling means admitting the story is over. And humans are narrative creatures. We don't abandon stories. We ride them into the ground. Yale researchers studied something called belief persistence. They gave subjects fabricated case studies about firefighters, some showing risk-takers made better firefighters, others showing cautious types were better. Then they told subjects the studies were fake, complete fiction, and asked them what they believed about firefighters. Subjects still believed whatever the fake study had told them. The story had been installed. The retraction didn't matter. Your portfolio works the same way. You bought Tesla because of the autonomous driving story. That story is now part of your identity. Even if the fundamentals change, even if Elon walks away, even if competition crushes margins, you'll find reasons to hold. Because selling means killing a story you've been telling yourself. And that creates cognitive dissonance so painful, your brain will do anything to avoid it. Look at WeWork investors in 2019. The company was valued at $47 billion. The story was perfect. Reimagining workspace, community-driven, millennial-focused, global expansion. Masayoshi Son at SoftBank poured in billions. The story was so good that obvious red flags, a charismatic founder with messianic tendencies, a business model that was just real estate arbitrage, billion-dollar losses, got ignored. When the IPO paperwork revealed the disaster, the valuation collapsed to under $8 billion in weeks. The people who lost the most weren't the ones who didn't see the problems. They were the ones who saw the problems, but couldn't abandon the story. They'd told their limited partners this was the future of work. They'd sat through presentations. They'd shaken hands with Adam Newman. Selling meant admitting they'd been seduced by narrative over numbers. That's harder than losing money. Here's your practical exit. The board meeting framework. Once a quarter, you hold a board meeting with yourself. You print out your positions. You pretend you're presenting them to skeptical investors who've never heard your stories. You must defend each position using only current data, not historical performance, not narratives, not potential. Just, here's what this asset does. Here's what it's worth. Here's why it's the best use of capital. If you can't make that case in 2 minutes without emotion, you sell.
This is what Berkshire Hathaway does at scale. Every portfolio company gets evaluated on current merit, not on how much Warren likes the CEO, not on the story of how they found it. Current merit only. The moment you let narrative override numbers, you've stopped investing and started fantasizing. The greed disguised as patience. Here's the lie you tell yourself. I'm not being greedy, I'm being patient. Warren Buffett says to hold forever. I'm thinking long term. Bullshit. You're being greedy. You're just using sophisticated vocabulary to hide it from yourself. Patience is holding a quality business through temporary market irrationality. Greed is holding any business past rational valuation because you want more. The difference isn't time frame, it's decision framework. Patient investors have sell disciplines. Greedy investors have excuses. Buffett does say hold forever, but here's what he means. Hold a wonderful business at a fair price forever, assuming the business stays wonderful and management stays rational. He's sold hundreds of positions over 60 years. He sold his airlines during COVID. He sold big chunks of Apple when it got expensive. He sold See's Candy's competitor when he found See's. Forever has conditions, massive conditions. But when you quote Buffett to justify holding your winner past rational exits, you ignore all the conditions. You weaponize one quote to defend a decision that has nothing to do with value investing and everything to do with dopamine addiction. There's a study from the Journal of Finance that tracked individual investor accounts over 10 years. The investors who had the highest returns had one thing in common. They sold their winners. Not all at once, but consistently. They trimmed positions as they appreciated. The worst performers did the opposite. They held winners and sold losers. They did this because holding winners felt good and selling losers felt like admitting defeat.
So they optimized for feeling over outcome, and they underperformed the market by an average of 3.8% annually. Compounded over decades, that's the difference between retiring at 55 and working until you die. Here's your practical exit, the valuation trigger. For every position, you write down the metrics that justified your entry: price-to-earnings ratio, debt to equity, market opportunity size, whatever, concrete numbers. Then, you write down the numbers that would make you wrong. If PE exceeds 40, thesis broken. If debt doubles without revenue growth, thesis broken. If 3 competitors enter with better tech, thesis broken. These aren't suggestions. These are automatic exits. The moment the trigger hits, you sell. Not tomorrow, that day. You've removed judgment from the equation. You've removed greed from the equation. You've pre-committed to rationality before your brain got flooded with dopamine and loss aversion and narrative lock. This is what separates professional capital allocators from gamblers with Bloomberg terminals. The comparison destruction loop. You exited your position at $80. Your buddy held. It went to $120. You made 300%. He made 500%. At dinner, he casually mentions his gains. You feel sick. You didn't lose money, you made money. But relative to him, you're a loser. And your brain, your status-obsessed, hierarchy-tracking, socially competitive brain, cannot handle this. You're not mad about your absolute return. You're destroyed by your relative position. This is the comparison loop, and it makes rational exit behavior almost impossible. Evolutionary psychologists call this local reference point bias. Your happiness isn't determined by absolute outcomes. It's determined by relative outcomes within your comparison group. A study at Harvard asked students,
Would you rather make $50,000 a year when everyone else makes $25,000, or make $100,000 when everyone else makes $200,000? Majority picked the first option. They'd rather make less money as long as they made more relative to their peers. This is insane from a rational perspective. This is perfectly logical from a neurological perspective. Status determined reproductive success for 200,000 years. Money has been relevant for 200. Your brain optimizes for status, not wealth. This is why traders in investment banks take stupid risks. They're not motivated by absolute wealth. Most are already millionaires. They're motivated by relative wealth within the trading floor. Being up 15% when your deskmate is up 20% feels like failure. So you increase risk. You hold longer. You reach for more. Not because you need it, because you can't stand losing the comparison game. And this psychology, which makes zero sense outside of context, destroys more wealth than market crashes. Because you're no longer investing based on opportunity. You're investing based on ego. Here's your practical exit. Comparison quarantine. You stop telling people about your positions. Period. You don't discuss entry prices. You don't discuss exits. You don't discuss returns. When someone asks how your investments are doing, you say, "Fine," and change the subject. This sounds antisocial. It's protective. The moment you externalize your positions, you've created a comparison game you cannot win. If you do better than them, they resent you. If you do worse, you feel inadequate. Neither outcome helps you make better decisions. The wealthiest families I've advised, the ones with 9-figure portfolios, they don't talk about money. Ever. Not because they're secretive, because they learned that every conversation about performance creates emotional anchors that corrupt future decisions. They've quarantined comparison, and that freedom lets them exit based on logic instead of ego. The math here is clear. A study in the Journal of Economic Behavior tracked 10,000 investors over 15 years. They divided them into two groups, those who discussed investments with friends/family and those who didn't. The non-discussers outperformed by 2.1% annually. That's $210,000 on $1 million portfolio over 15 years. The cost of comparison is measurable, and it's expensive as hell. Your need to be right in front of others is taxing your returns at 200+ basis points a year. That's more expensive than most hedge fund fees. You're paying a massive premium for the privilege of feeling inadequate or superior relative to people whose opinions shouldn't matter to your capital allocation decisions. The wealth preservation shift. Here's what changes when you have real money. The goal shifts from making more to keeping what you have. But your brain doesn't shift with it. Your brain is still in accumulation mode, still hunting, still reaching. This mismatch destroys generational wealth faster than anything else. You made $10 million. That's enough to never work again if invested conservatively. But conservative investing feels like surrender. Feels like you're getting old, scared. So you keep swinging for home runs. And one swing, just one, wipes out what took 20 years to build. There's a concept in wealth management called the ruin probability curve. Every investment has a ruin probability, the chance it goes to zero. Individually, these probabilities might be small, 2%, 5%, even 1%. But if you keep making bets with ruin probability, the cumulative chance of eventual ruin approaches 100%. It's not a question of if, it's a question of when. Professional gamblers understand this perfectly. That's why card counters get kicked out of casinos, not because they always win, because they've eliminated their ruin probability. They only bet when odds are in their favor. and casinos can't make money against someone with zero ruin risk. Look at the statistics on lottery winners. 70% are broke within 5 years, not because they spent it all, because they kept playing. They took their $10 million and tried to make it $100 million. They invested in restaurants, tech startups, their cousin's brilliant idea. They didn't shift from accumulation to preservation. They kept the same psychology that made them buy lottery tickets in the first place. And that psychology, which occasionally wins, eventually, always loses. The math guarantees it. You cannot beat ruin probability with optimism. Here's your practical exit: the withdrawal sequence. Once you hit your enough number, and you better have one, you start withdrawing, not spending, withdrawing into safety. Every quarter, you take 5% of your risk positions and move them to boring stuff: index funds, bonds, real estate, things that don't 10 times but also don't go to zero. Within 5 years, you've rotated 50% plus of your wealth out of risk. You still have upside exposure, but you've eliminated ruin probability. This is what every successful entrepreneur does after their exit. They diversify immediately, not because they lack confidence, because they understand the math of preservation is different from the math of accumulation. And confusing the two is how you end up broke with great stories. The final truth: exits aren't about market timing. They're about life timing. You don't exit because you know what the market will do tomorrow. Nobody knows. You exit because you've decided what you need your capital to do for the next phase of your life. That's the shift. That's the maturity. That's the difference between rich people and people who were rich once. Rich people use markets to fund lives.
Poor people use lives to play markets. One group has wealth, the other has screenshots. Think about exit this way. Every position has an expiration date. You just don't know what it is. The company could fail, the sector could collapse, you could die. Something will end the position eventually. The only question is whether you choose the ending or it chooses you. Choosing feels like you're giving up upside. Not choosing feels safe. But not choosing is the most dangerous choice. Because when the market chooses your exit, it's never pretty. It's never planned. It's always at the worst possible moment with the worst possible consequences. You're selling in a panic to cover a margin call. You're liquidating to pay medical bills. You're dividing assets in a divorce. These aren't investment decisions. These are surrenders. The richest people I know, and I know people with more money than small countries, they all have one thing in common. They exit before they have to. Always. They don't wait until the metrics turn. They don't wait until the story changes. They don't wait until everyone agrees it's time to go. They exit while things are good, while buyers are excited, while they could easily justify staying. This looks like cowardice to poor people. It's actually courage. It takes more guts to walk away from a winning position than to hold through a losing one. Because walking away means accepting that you'll never know how high it could have gone. And your ego hates that uncertainty more than your wallet hates losses. Warren Buffett has a famous rule: never lose money. Everyone quotes it. Nobody understands it. They think it means only make winning investments. Wrong. It means structure your decisions so that even your failures don't create ruin risk. It means exit while you're ahead, even if ahead could become more ahead. It means the money you keep is worth more than the money you might make. This is a mathematical statement, not a philosophical one. $1 in your account compounds. $1 you might make someday has zero present value. Your brain doesn't think this way. Your brain values potential over actual. That's why you're not Warren Buffett. Here's the framework that changes everything. You don't own positions. You rent them. Every position is temporary. You're renting this stock, this business, this investment for as long as it's the best available use of your capital. The moment something better comes along, you swap. No attachment, no story, no ego. Just, is this the optimal place for my money right now? If yes, hold. If no, exit. This sounds cold. It is cold. It's also how you build generational wealth. Because generational wealth isn't built by finding one perfect investment and holding it forever. It's built by making 10,000 good enough decisions and avoiding the 10 catastrophic ones. And catastrophic decisions all have one thing in common: staying too long. The door is open. The physics are simple. Money in motion compounds. Money in your head disappears. You know this. You've always known this. The question isn't whether to exit. The question is whether you're brave enough to choose your ending instead of waiting for the market to choose it for you. That choice, that moment of conscious decision, separates people who die rich from people who die with stories about how rich they almost were. You don't need perfect timing. You need any timing. You need to be the person who exits at 80 when it goes to 100, not the person who holds at 100 and rides it back to 40. Because one of those people sleeps at night, and one of those people tells stories at parties about the one that got away. Choose sleep. Choose profit. Choose closed trades over open wounds. The market will always offer another opportunity. Your capital only regenerates if you protect it. That protection starts with the exit you've been avoiding. Today. Not tomorrow, not when it hits your number. Today. The rocket's in orbit. Time to fire the thrusters and come home. The landing is the only part that matters.